Have you ever just looked at the stock market and wondered why it seems to have, well, mood swings? One day it's calm, the next it's just complete chaos. Well, back in 1994, a team of researchers, Jacquier, Nicholas Polson, and Peter Rossi, figured out a way to understand that rhythm. This is the story of their incredible paper and the clever computational key they built to unlock a problem that had stumped everyone for decades.
Right? It's such a core question. One month, prices are just kind of drifting along, no big deal. The next month, it's a total roller coaster. This whole phenomenon, where you get these clusters of calm followed by clusters of stormy periods, is one of the biggest puzzles in finance. It's often called volatility clustering.
So let's just be clear on what we mean by volatility. On one side, you've got a low volatility market. Think small, gentle, pretty predictable price changes. And on the other, you have high volatility. We're talking big, sudden, jagged price swings. Being able to see that shift coming, that's the holy grail if you're trying to manage financial risk.
For decades, economists were on a quest to find a reliable way to model this hidden rhythm. The goal was never just about looking back and saying, oh, yesterday was crazy. No, it was about trying to anticipate when the market's entire personality was about to flip from calm to chaotic.
By the early 90s, a really elegant theory for this had started to take shape, but it had this one giant catch. It was a beautiful, intuitive model that was, for all practical purposes, totally impossible to actually use. It was like having the blueprints for a revolutionary engine, but having absolutely no tools to build it.
The theory was called stochastic volatility. And the idea itself is actually super intuitive. It basically says that the storminess of the market isn't some fixed thing. Instead, it's a random or stochastic process that's always changing. Think of it like the weather, right? The temperature is a random process, and so is the wind speed. This theory suggested volatility has its own hidden pulse, which just felt so much more realistic than any other model out there. But that realism came with a seriously steep price.
And here it is. This was the wall. To get this beautiful model to work, you had to solve this unbelievably complex equation. It was a monster math problem. Imagine trying to predict the exact path of a single raindrop in the middle of a hurricane, but for thousands of data points all at once. For any real-world data, it was practically impossible to solve directly.
Now, it's not like people hadn't tried to crack this problem before. But as the paper points out, all their tools were just clumsy. Some methods were really inefficient, kind of like a clumsy lockpick. Others relied on approximations that would just fall apart, especially in calm markets. They were all trying to force open a lock that was just way too complex.
This is where Jacquier, Polson, and Rossi come into the story. Instead of trying to smash down the door with pure mathematics, they found a secret passage. And they did it by using computational power in a brand new way. They completely changed the question from, what is the one single right answer, to, hey, what does the entire landscape of possible answers look like?
Their technique is called Markov Chain Monte Carlo, or MCMC for short. And here's the absolutely brilliant part. Instead of trying to solve for one specific number, they just treated the hidden volatilities themselves as part of the puzzle to be solved. They built a smart guesser, an algorithm that could just wander through the entire universe of possible solutions, taking thousands and thousands of samples. And by looking at where that algorithm spent most of its time, they could map out the most probable answers.
And you can see the core of their idea right here in their own words. The key phrase is to augment the parameters with the time series of volatilities. In plain English, that just means they added the entire history of those hidden ups and downs to the list of things they were trying to figure out. That was the secret passage that let them bypass that impossible math problem completely.
Okay, so the theory is just brilliant, right? But the real question, the multi-million-dollar question is, did it actually work? Did it work any better? Well, the authors didn't just propose the idea, they put it head-to-head against all the old approaches in a bunch of rigorous experiments. And the results, well, they were stunning. Just look at this. This chart shows the average error for the different methods. You can see the older approaches, a lot of error. But the new Bayesian MCMC method, wow, its error was consistently and just dramatically lower. They hadn't just found a better key, they had found the right key.
And let's put a number on that. On average, their new method was more than twice as accurate as what came before. This wasn't just a tiny step forward. This was a massive, game-changing leap in performance.
And get this, there was a bonus. Because the algorithm estimates the entire history of volatility as part of its process, it also gives you the best possible guess of what happened in the past. This is known as the smoothing problem, and other methods needed a whole separate clunky process to even attempt it.
Here, it just came along for the ride, totally free.
So what's the lasting impact of all this? It was never just about this one model. It was about introducing a powerful new way of thinking to the entire world of finance, a toolkit that traded brute force math for intelligent, powerful simulation.
So why does this paper still matter so much today? Well, for the first time, it made these incredibly powerful and intuitive models actually usable. It gave us a way to get exact answers without having to rely on fuzzy approximations. And really, it just kicked the door wide open for a whole new generation of computational methods in finance.
This whole story leaves us with a really fascinating thought. This was a 30-year-old math problem that wasn't solved by some new, brilliant equation. It was solved by a new, brilliant way of using computers. And it just makes you wonder, right? What seemingly impossible problems are we staring at today that aren't waiting for a genius, but are just waiting for the right algorithm?
If you want to dive into the details for yourself, you can find this landmark paper in the October 1994 issue of the Journal of Business and Economic Statistics. It's a fantastic read. Thanks so much for tuning in.